Okay, there we go. Recording in progress. Good. We're good to go. All right. So, welcome to the monthly Patreon call, guys. I'm just going to go over all the topics that we were discussing before, and we'll get right to it. And then after that, we'll do some Q&A. So, the first thing I just want to talk about is Celsius. Um, Celsius has been a great play for us so far. I think that the company is doing exceptionally well in terms of branding and marketing, and there's still a lot more room for the upside for them in the future. So if you are invested in, just making sure that this is a good company going into the next 5, 10 years, it is. The one thing I will say about people that are holding on to some of the spreads, I did not expect this company to get to $100 that quickly, but that's just how the market works sometimes. The market can really, give a lot of great price appreciation in a very short period of time. They had a great quarterly report. A lot of the issues that the analysts at Bank of America were speaking about with regards to slowing down in their sales was absolutely true. But what they didn't account for was that it was actually some seasonality behind it. So I think a lot of investors are starting to figure that out. All the analysts, they started to really give these guys a lot of upgrades. And so now everyone is jumping into this company. But alas, it's a little bit late to do that. So at $50, I think Celsius was very undervalued. But at $100, around $90, in today's realm, I would say that it's more or less fair value. So if you're looking for a substantial amount of return going from here, it's not necessarily going to come unless you hold for for some time, and that's not a bad thing. You really want to hold on to great companies over a long period of time, and they'll price appreciate over time. So right now they hit about 23 billion in market cap, which is I think a third of Monster, but they don't have a third of Monster's revenue yet. I think eventually they can get there, but it's going to take some time for them. So I'd say for those holding on to the spreads, you got nothing to worry about. Just hold on to those spreads. Basically, over time, the $100 spreads that you may have sold, they will depreciate in value and they'll decay slowly. Um, there's really not much else to do and just wait. I'd say we've got another 6 to 9 months of solid waiting, and a nice 4 or 5x return. And hopefully Celsius stays close or above $100 by the time we get to 2026. So if you're holding on to those Celsius spreads, congratulations, you're done doing well. It's the same exact thing that we're dealing with when it comes to Verizon. Verizon went from $32 to over $40 rather quickly. Verizon's business is actually doing well too. Their cash flows are actually so. The next thing I wanted to quickly talk about is inflation. Lately, the numbers that I'm seeing with regards to inflation, they're starting to pick up slowly. Um, it doesn't mean that we're in another super cycle of inflation. It just means that right now, the deflationary impacts that we were seeing initially, they're starting to like slow down. So what does this mean? That means that the market right now is expecting a lot more rate cuts than are coming our way. Now, a lot of companies were hoping for these rate cuts as part of their business models, and that doesn't seem like it's going to pan out this year. Now, this doesn't mean that it can't change mid-year because it definitely can. But a lot of the things that we could not have predicted started to really rise in value over the last couple of I would say couple of quarters actually, that they're finally starting to see now in the data points. The biggest one is homeowners insurance and car insurance. Not a lot of people understand, but a lot of these things are lagged because they require regulatory approval from the areas they operate in. And a lot of them now have the ability to do that. So what does that mean? That means that people are paying a lot more for insurance, and a lot of those insurance costs are going to be impacting people's ability to spend money, essentially. So that's going to cause inflation to happen. Now, what does this mean? Does this mean that, hey, interest inflation is here to stay? No, it just means that the counterpoints that we were seeing that led to disinflation are actually reversing a little bit, and we're just seeing a lot more normalized inflation rate. So right now we're heading back to about 3. Now the Fed's goal is to get to 2, but I'm not sure that they get to that anytime soon. So even the Fed is likely to pivot to say, you know what, 2.5 is good enough. So basically, we're in a place where inflation is starting to kind of creep back up a little bit, but it's nothing to worry about. I think a lot of this is going to be very, and I hesitate to use the word transitory, um, but the market is definitely going to punish a lot of companies. I think we've lived in a very good market for the last 3 months. I do think that we're due for a small pullback, nothing major that's going to like resemble what we saw in October, but it also means that we just have to make sure that we're hedging ourselves so that just in case something does come, that we have some liquidity on the side that we can deploy some money into. Because the biggest thing is the problem that I see a lot of people face is that they wait for good opportunities, but then when it comes time to pull the trigger, they don't. And a lot of times what happens is they'll FOMO into the market and then they'll deploy all their money at the top. And then when they deploy their money at the top, they don't have money when things get pulled back. So I think we're due for a small pullback. It just depends on which company we're talking about. And right now there's not a lot of opportunities in this market for anything that would require great returns. There is one sector that I have been deep diving into and researching, and that is commercial real estate. A lot of people will say commercial real estate is dead. The news media loves to eat it all up and just say, hey, listen, all these regional banks are going to go out of business. Commercial real estate is going to go out of business. But that's not how things are actually working out on the ground. When you do due diligence on the ground, you're actually seeing that depending on the classification of building, you're actually seeing leasing rates starting to improve. You're starting to see a lot of foot traffic return. Now, that doesn't mean that it's all 5 days that that's happening. I think a lot of companies are still doing a remote slash hybrid work schedule for most of their workers, but even that is shifting back to a 5 day work week, in person. And those things are starting to kind of show up in the leasing rates. So one of the things that I saw was a CBRE, which does a lot of leasing for commercial office buildings. They had a report out that basically highlighted this, saying, "Hey, look, you know, I think we've hit a theoretical bottom in terms of like where the valuations are commercial real estate." Now, there is one major challenge that's happening in the commercial real estate market, and that's the refinancing portion. Typically, a lot of regional banks did lending into the space. They have almost all pulled back. They said, look, we need to preserve our capital. We need to save our money. We can't take any risks right now. So they're pretty much sitting it out. That leaves a giant opening for alternative asset managers to come in and soft money to come in from other parts of the market and buy up these assets at really discounted prices. One of those companies right now is called Brookfield Partners. Brookfield Property already owns a significant amount of real estate. Um, and they're mostly class A real estate. So it's nothing that you're going to see that's like, suburban tier 3 city. This is class A buildings in not just the United States, also by the way, all across the world. And so their leasing rates are actually starting to recover faster. What's interesting is those their preferred shares, which are a combination of kind of like debt and equity, those are actually trading at a significant discount to what their book value should be. So based on what I'm seeing, that actually presents a pretty good opportunity to be in this. So one of the things that you get when it comes to preferred equity, let me just show you what it looks like. Um, it looks like this. Hold on, share screen, Chrome tab, window. Okay, there you go. So okay, so you can see here, this is Brookfield preferred equity for Brookfield Property Partners. Brookfield itself is a mega corporation. They're not a small mom and pop shop. They've been around for almost 100 years. These are all the different preferred equities that they have listed. Now, I'm just going to quickly go over what this means. This means this is the ticker symbol on the NASDAQ that you can buy it under. So BPYPP, BPYPO, each one of these represents a different class of preferred shares. This is series one, series two, series three, and this one is a brand new one that they came out with when they took the company private. Now, this right here is the distribution that you would get for holding on to this specific ticker. Now, what does this 6.5% mean? This means that at the valuation, like at the redeemable price, that is where that 6.5% is generating. So basically, for every $25 that you lend to these guys, they will give you $6.50 per year. Now, that is when it was first issued. Right now, that same security, like BPYPP, is actually trading at $14.20. Now, what does that mean? That means that your actual yield is going to be about 11.4 because you're buying it at a discount. The good thing is, let me just go back to the thing. The good thing is, a lot of those series that are listed, they're all selling at discounts. The one that I'm most interested in is something called BPYPM. The reason for that is that one was a series that was created when BP Brookfield Property was taken over, and there are assets under there that are way more valuable than what the other ones have, even though they're all guaranteed technically by the same company. What happens is there are underlying assets that are guaranteeing each one of those that are a little bit separate. So BPYPM to me feels like the most compelling. The other thing is they actually issued not too long ago a a filing that pretty much means that they can actually go into the open market and buy that one back. There's also a lot of liquidity in that one because it has the most shares outstanding. So it means that in the future, if you wanted to sell, you could sell without, losing too much on slippage. So
we own directly on Brookfield Corporation's balance sheet. And really the difference between the strategy with these assets versus our funds is the funds mostly exist within closed-end fund strategies, where we have a defined period of time to invest that capital, put it to work, and then return it to our shareholders. What's unique
why is that happening?
about our balance sheet is this is forever capital. And as Bruce mentioned earlier, our plan is to hold these assets over very long periods of time and continue to focus on improving them, keeping them full, and making them resilient for the future.
Can you guys hear and see that screen? Yeah? Okay, good.
And the beauty of that is we don't need to focus overly on prices on a daily, weekly, or monthly basis. Prices are only relevant when we're ready to realize on some of these assets. And so as a result, a lot of my focus today is going to be on fundamentals and what's happening, because the press loves to simplify things. And the simple story today focuses on a broad swath of real estate. But what we're seeing on the ground and within our operations is the widest divergence we have ever seen between the performance of high quality real estate and the rest of the market. So as we sit today, our portfolio, which is comprised primarily of very high quality, in fact, we think the premier portfolio of core real estate that's ever been assembled, is meaningfully outperforming the market. I'm going to walk through what that means and give you a few examples of why we think that's happening. Within the portfolio, we have a number of opportunities to put new capital to work at very attractive rates of return. And because of the size and strength of our balance sheet and the liquidity from all of our other businesses, we've been able to withstand what we think is the most volatile debt capital markets that we've seen in some time. So as a result, with interest rate increases largely behind us, we think as going forward, we will be continuing to deliver on strong cash returns as we have for the past 35 years. In summary, our real estate investments today, Nick touched on this earlier, is about $24 billion. About 60% of that is invested in our premier core portfolio. These are the best of the best. The balance, the remaining 40%, are invested in shorter duration development and redevelopment assets. Our premier core portfolio is just a handful of assets. And so we're going to spend a little bit of time understanding what is in that $14 billion of value and what really underpins it, because it's easy to do. It's just a few assets, 29 of them, in fact. The performance of these 29 assets has been exceptional over the last 12 months in the face of a challenging real estate market. So despite what you've read about, net operating income in this portfolio is up 6% year over year. The portfolio is virtually full and it's leased on a long-term basis, and we're conservatively financed. And this is a really important part of our investment strategy with real estate, is this is a cyclical business. These are illiquid assets. We need to be able to hold them through good times and bad. And so what that means is our financing strategy on each of these assets is asset level, non-recourse financing on each individual property.
So right there is a very important thing to just mention really quickly. When it comes to, let me just pause the sharing real quick. Screen shares, pause, play, whatever. Stop sharing for a second. So the first thing I want to talk about is something called non-recourse loans. Brian is actually going to go through it real quick, but I'm going to do a good deep dive into it for you guys. So when it comes to property ownership, you can buy property as a single entity, right? So if you are a corporation, you buy property. Every time you buy a property, you're putting it under your umbrella saying, hey, I am the guarantor behind this property. And the bank is lending you money based on that asset, of course, but they're looking at you as the borrower and saying, I'm gonna lend you money. When it comes to non-recourse, what that means is that, think of it this way: if you buy 5 different buildings, what you're essentially doing is putting a mortgage on every building individually. When you do that, it sucks in terms of doing the paperwork, because every single time you have 5 different monthly payments, you have five operating entities that you have to manage. So it costs more to do it. But Brookfield does that, and a lot of commercial REITs, especially when they get to a really good size, they all do that. The reason why is because today we're in a scenario where certain properties are going to be exceptionally well. They are fully leased out. They're doing great. And then there's other buildings that you may have bought that, maybe they're 70% occupied, and it doesn't make sense to keep paying the mortgage on it because you're not making any money. Now, how does Brookfield deal with that? Well, they Brookfield, and just like every other REIT, can basically say to those non-performing assets, we don't want them. We could just hand back the keys to the lender, and it doesn't impact the balance sheet of the entire company. So a lot of times people are looking at the news and saying, oh, Brookfield defaulted on a property in Denver. That means that, Brookfield is not paying their money. No, it just means that Brookfield decided, hey, the property that we have in Denver, it's not worth paying the mortgage on. So hand the keys back to the lender. A lot of times the lenders, because they're not in the they're not in the business of, dealing with commercial real estate, they'll actually go back and say, hey, listen, maybe we can renegotiate a deal. Maybe we can extend out the loan another 5 years at the same rate that you currently have. And so a lot of times these commercial developers, they utilize this tactic, and they do it with great effect, so that this way their business is not as negatively impacted. So the buildings that are making really good money, they hold on to those. The ones that are not doing as well, they can give them up, or they can refi them, renegotiate, and do all sorts of things to them. What's also very interesting is, at the same time, Brookfield is actually going out and acquiring new assets. They're actually buying foreclosed assets, which I'll go into a little bit later. Let's keep watching this one, and then we'll go from there.
This is a cyclical business. These are illiquid assets. We need to be able to hold them through good times and bad. And so what that means is our financing strategy on each of these assets is asset level, non-recourse financing on each individual property. It's extremely labor intensive. It's a lot of work putting together and managing a debt book like that. It's a little bit more expensive than doing everything on a consolidated basis. But when we go through periods of time like we're experiencing right now, that's when the insurance pays for itself. So how did we grow NOI by 6% in such a challenging market? It's really a combination of 3 things. Number 1 has been strong occupancy gains. As the portfolio emerged from the COVID lockdowns, we've seen occupancy within our assets return to more normal levels, which has provided quite a boost. Additionally, even though they're leased on a long-term basis, our leases include contractual rent escalators. Sometimes they're fixed annual uplifts. Oftentimes they're tied to our tenant sales, which have been skyrocketing.
Now, what this essentially means is that, when you do commercial real estate, it's not just, oh, here's the rent for the next 15 years. This is what the price is. What they do is they say, here's the rent, but year 1, it's this. Year 2, it's going to be 3% more. The year after that is 3% more. Year after that is another 3%. So it keeps adding to the amount. So if you think about it, even if right now your rent is below your total NOI, which is your cash flow that you can generate, over time, you will be able to get to the point where you're cash flowing positive again. And I think that's a very important concept to remember, because if you think about, if you do the math, if you annualize out those rent increases over time, they actually can be very substantial depending on the asset that you're talking about. So
Rocketing over the past couple of years. In addition, on average, our leases are about 12% below market. And so there's a natural mark to market as leases renew on an annual basis. As I mentioned earlier, our debt maturity profile is a well-laddered portfolio. We have about 15% of our debt coming due in any given year. And so what that means is there's no wall of maturities. So when we do go through periods of time where liquidity is more constrained, it's manageable. More than 50% of our debt doesn't even come due for the next 5 years. Half of our core portfolio is invested in our core office and mixed-use developments. These are 10 iconic assets in 5 cities around the world, fully occupied on a long-term basis. You've been to probably most of these assets, so within the portfolio, a significant portion of the capital is invested in office. And what's happening in office markets today is, as I mentioned earlier, a wide divergence between high quality, unique, fit for purpose office and older commodity office space. And so you can see from this page, this portfolio is fully occupied. All of our tenants are paying their rent, and we have a long-term lease in place. Importantly, though, along with the office that's in this portfolio is the ancillary retail and residential that sits alongside of it. And this is really the differentiator for this type of office product and where we're seeing tenant demand today. So a great example of where these 3 things all work together is the building that we're in today, Brookfield Place here in Lower Manhattan. Over the last, if you go back 20 years ago, this was primarily a financial services office complex. On Friday at 5 o'clock, we locked the doors and we reopened things on first thing on Monday morning. Over the last 20 years, as the residential population has boomed in Lower Manhattan, we've gone through a huge transformation of the complex and really reimagined what it could be, changing the type of retail tenants that were down and turning this really into a 7-day-a-week tourist destination with some of the highest productivity retail in all of New York City. As we sit today, our tenant sales for our luxury retailers are up over 30%. But more importantly, the office is at the highest occupancy that it has ever been at. And over the last 18 months, we have completed 1.1 million square feet of leasing here in the complex at the highest rents we've ever achieved. In-place rents at Brookfield Place are 20% above the surrounding market. And so there is a huge difference between office product like this that is fit for purpose, that's desirable, that companies want to locate in, and the traditional commodity office space that is becoming functionally obsolete and that we're reading so much about in the press. Another great example of this is Canary Wharf in the City of London. Just like Brookfield Place, when it was originally conceived of about 30 years ago, it was focused on financial services tenants. At the time, it was a pioneering location on the east side of London with limited transportation. Over the past 30 years, though, that has changed with the development of the Jubilee Line, first in 1999, and then most recently the completion of the Elizabeth Line, which now provides direct connectivity to Heathrow Airport on a single train in 40 minutes, as well as London City Airport in just 15 minutes to the east. This is now the most transportation-linked office complex in the City of London and has had a dramatic change on the area, not only within the Canary Wharf complex, but in the immediate surrounding area where literally tens of thousands of new apartments and residences have been built over the last 20 years. So going back through the evolution of Canary Wharf, when it was originally conceived of, about 60.
So one of the things is, a lot of developers here have exposure only to United States. What's good about Brookfield is that they have an international presence. So they're everywhere, not just here in the United States. By being in other locations, they're getting that diversification. So if you look at the leasing rates in the United States versus in the other parts of the world, they recovered much, much faster than we did. So in terms of like returning to office, if you look at the occupancy levels that they have in Australia, in the United Kingdom, they're already back to pre-pandemic levels. So while we are transitioning back to it, these guys are already recovering nicely.
percent of the value was in financial services office tenants. There was some retail that was really there to support the office users, but the precinct itself was largely a Monday to Friday 9 to 5 destination. Over the last 15 years, though, we've introduced residential apartments as well as hospitality offerings and fundamentally transformed the type of office tenants that are located there, even within the office buildings. And so today, less than half of the value of the estate is actually with financial services office tenants. And our plans for the future will be even more dramatic as we now have established Canary Wharf as a life sciences and tech and innovation hub within the City of London. And so our plans there, in addition to the existing assets, is a significant build out continuing on residential as well as lab space. Through the pandemic was the importance of bricks and mortar retail. It allows them to interact with their customers and serves as really as a marketing hub where they can drive higher margins. And so since emerging from COVID, we've seen a dramatic turnaround in the demand for this very high quality shopping space. As we sit today, net operating income this year is up 10% year over year, which rivals most of the highest performing real estate sectors. The portfolio is conservatively financed, but importantly, we're full. It's 97% occupied, and most of these centers have waiting lists of tenants waiting to get in.
The fact that these guys can have that kind of leasing rate speaks to the quality of buildings that they have and the quality of assets that they have. It's very important to understand, when it comes to retail space, you live and die by the occupancy levels that you have. The higher occupancy, the better. The less occupancy, that means that basically it's just, collecting dust and you're not collecting any real revenue from it. So these guys, they have a very high occupancy rate. And that's primarily because where they are located, they are very careful in putting in retail in locations where it's actually going to be desirable, and not just desirable at like the small level, but at the high level. So you're going to have mixed use things that are going around it as well. So when these guys, they buy something, they don't just buy random plots of land and say, okay, let's make a store there. They actually buy things and build around it to make it very commercial friendly. So if you're in New York City, go to Brookfield Place, you'll know exactly what I'm talking about. So once again, they don't just have presence. I'm going to stop this video for now. I think we're done with that part anyway. But they are very, very diversified. And I'm going to quickly just share a tab with you guys to show you this right here is all the different things that they have. They don't just have office properties, they've got retail, they've got logistics centers, multifamily, self-storage, student housing, manufactured housing, even single family rentals, triple net leases. All these things, they provide a huge level of diversification that you're not necessarily going to see from a lot of other property REITs that are out there. So right now, in terms of valuation, if this was just office, I would be a little bit worried and a little bit skeptical, because that means that now you're kind of relying on that one asset class to do majority of your revenue. But even though it's an outsized portion of their total value, the rest of these things do generate positive NOI for these guys to basically, keep them afloat while all this stuff is happening. The good thing is they've been actually able to opportunistically add things that are in foreclosure. So if you look at one of the giant acquisitions that they actually bought 75 multifamily buildings in San Francisco with, I think, almost, I don't know how many apartments. That's a ton of apartments. And they bought it in foreclosure at a very discounted price. These kinds of things are what you want to see in an asset manager, so that when things are bad, they have the capital and the liquidity to go in and buy these things. And this way generates us as investors positive returns later on. So think about all the companies that bought up houses during the 2008 financial crisis. After that, they just absolutely made a killing for the next 10 years. And Brookfield is doing the same exact thing right now in the office space. Now, here's a question that I had to ask myself. I had to go through all this stuff. Where are they getting all of this additional money from? If I just said before, hey, regional banks are closed for business, where are they getting this money from? Well, the thing is, Brookfield has the ability to reach into private investors. Private investors like hedge funds, PE funds, foundations, they have a track, they like going with people who have a good track record, and Brookfield has that, and basically saying, look, we can take your money, we can deploy it, and we can give you a great return over a long time, and we'll make sure that you're taken care of. And basically a lot of that money is going to Brookfield now, so they've been able to raise a ton of capital that way. Now there was a very interesting comment that someone said, well, Chris, what about insurance? If insurance rates are going higher, doesn't that impact these guys? And to some degree, yes, but Brookfield, in their big brain ideas, in 2001 they started to do something that was very unusual, but actually was a masterstroke in financial discipline. Well, not just discipline, but basically it was a really good strategy. What they did is they started to buy insurance companies. When interest rates were super low, they started to buy insurance companies. Now, why did they buy those insurance companies? It's the same thing that Warren Buffett did with Geico. When you think of an insurance company, essentially what an insurance company is doing is you are giving them money, they're taking that money, investing that money, getting a return, and eventually in the future, they're paying that money out to you as a basically a guarantee. And the entire time that you're paying these guys insurance, all that money is just stacking up, it's just sitting around. These guys in 2021, when interest rates were super low, they were able to buy these insurance companies for a very good price. And what happened was they didn't go out and buy 30-year treasuries. That they did was they bought short duration bonds. Now what does that mean? That means that as interest rates go higher, as those investments that they made with the money that they got from the insurance, that they sold, they're able to deploy that into other areas that are generating much higher returns. So right now Brookfield is actually very well capitalized, and their insurance segment is generating a ton of cash flow that they're able to redeploy into really high quality stuff that's going to generate a ton of capital going forward. So they're not having to rely on the banks for financing. They're actually able to self finance through foundations, but also from their insurance business now that's generating them cash flow, which they can use that to deploy. So if you know how Warren Buffett got one of Warren Buffett's main things is he uses money from Geico. Basically, you pay Geico for insurance on your car, that goes to Warren Buffett. Warren Buffett's taking that money and investing it and getting a really good return, and then just paying you out whenever you get into a car accident. So the insurance business is a good one. The only thing is you have to be very careful with insurance that when you take on a liability, you also at the same time don't go way out into the future in terms of trying to get a fixed return. So imagine right now all the insurance companies that bought 30-year treasuries at 2 years ago getting maybe 3% per year. They're not going to be doing well. These guys could have done that in 2021. They could have said, let's go out there and buy short, long duration treasuries. They didn't do that. They kept them very short. And now, as inflation goes higher and the Fed keeps interest rates higher, they're able to reinvest that money in higher yielding assets. Also, it gives them a high level of liquidity that they can deploy into buying assets while other people can't, because other people don't have the ability to raise capital. The fact that these guys can raise capital, raise liquidity, and basically capitalize on this current market, perfect. And once again, it provides a huge level of security for us as investors. So Brookfield right now is very undervalued. As a company itself, they're traded under the ticker symbol BN. But I would rather be in the preferred. So someone on Twitter asked me a really good question. They said, Chris, why are you not in the common equity in Brookfield Corporation? Why are you sitting in the preferreds? The reason why is because the preferreds are basically trading at 50 cents on the dollar, and they get giving you a fixed return. So the return, you're getting almost a 12, 13% return just for buying the preferred share. And then eventually those preferred shares, once the market wakes up, they'll go back to trading at 25 again, which means that we'll get a double. So I think within the next I'd say probably a year and a half to 2 years, you're going to see these preferreds rise up in value. And at the same time, you'll be collecting really good dividend payments. So in terms of investing, this is a really good play. Um, especially if you buy it in a tax deferred account. The one major problem that people are going to face with this one is that if you buy it in a just a regular account, any of the interest payments that come to you, they will be classified as ordinary income. If you get classified as ordinary income, that means that it's just like you're working a day job. You have to pay taxes on that. But if it's in a non-taxable account, there's no taxes that you have to worry about. It doesn't generate any UBIT, so you don't have to deal with that. And then the last thing is when it comes to preferred equity, there is a level of differentiation that you have to talk about between the preferred. So, someone right now in the comment section, they're asking, what's the difference between BPYPO and BPYPM? BPYPO and BPYPM, they're two different series, and there's two different things that are classifying them. So, one, they have two different maturity dates where the where the company can actually redeem them at a at a different date. So that's one. And BPYPM, there's different assets that are securing that one versus BPYPO. I'm gonna just save a lot of this stuff for the Patreon post that I'm gonna do later on because I think that will help me explain it. It's really hard to explain it like verbally without showing you guys all the data points, and I don't want to go through like 10 different screens just to show you guys. But this was a very smart move. This is a great company. Long term, it's not going anywhere. Great assets. And right now, the thing that I'm looking for in my portfolio more than anything is probably security. I don't think Amazon's going to double tomorrow. I don't think Google's going to double tomorrow. I don't think a lot of these companies are going to double tomorrow. They'll give you a good return, but the valuations are fair. Whereas this is actually undervalued by a lot. And so I would say to you guys, consider BPYPM in your portfolio. I mean, I know in the US, you guys will be able to do it very, very easily, depending on which broker you have, because not all brokers have it. If you want to, long term, BPYPN is a really good long term hold. For people here that are probably retired and looking for fixed income, I'd say buy some BPYPM. I think that would, I'm not giving you financial advice. This is not financial advice. But if you are retired and you're looking for a nice, stable return that you're going to get paid every 3 months, this is the one that you want to look at. Not only will you get capital appreciation, but you'll get a nice 13, almost 12 to 13% dividend payment per year, which means every quarter you'll get 3%. Some people have mortgages at 3%. Bro, one quarter will pay your entire mortgage for the year if you have that kind of money on the sidelines. So BPYPM, high conviction buy for me. Great company, backed by a great sponsor. They have tons of liquidity. That basically means that they're not going bankrupt anytime soon. The short term, right now, you're going to see a lot of negativity because of the whole commercial real estate aspect. But I don't think that there's anything to worry about long term. I think the market is starting to recognize that, and that's why you're seeing some of the prices get bid up. I have a significant position in BPYPM. I'm also going to be buying BPYPN, which is another preferred. It's trading at even a lower value. The only thing is BPYPN has a lower interest rate that they'll give you on it, but it's fine because if you, it's math. It's math. I'm gonna stop here and let you guys ask some questions. So if you guys want, raise your hand and I will unmute. Well, and then just unmute yourself once I say your name, and you can ask me some questions. So go ahead. I don't know if anyone has any questions. So if anyone's got questions, start asking. I'm sure someone's got a question. Anyone? Any questions so far? Okay, June Kim. I think you just raised, gave me a thumbs up, but go ahead, unmute yourself and ask a question.
Yeah, sorry, I don't know why I can't find the raise hand. Oh, okay, now I see it. Okay.
Yeah.
Okay, perfect. So I guess in your kind of coverage with BPYPM and whatnot, like what about and I might have missed this, but in terms of just looking into investing in just Brookfield, like BN overall, ticker symbol BN, like what's your take on that? If let's say, for example, you have no access to via Robinhood? Because I know that that discussion has been going around where you have to have Merrill Lynch or some other, other brokerages. And frankly, for me, it's like I just prefer to just have it in Robinhood for now. That's been my main brokerage and whatnot. So understandably, I know I'm restricting myself purposefully, but what does BN look like in general, just as that ticker?
So BN is actually very interesting. Their book value or their net asset value should be in like the $74 range. They're trading at like 50 right now. So there is a significant discount that you're getting. BN is a great investment over a long period of time. These guys are likely to CAGR between, and according to them, between 15 and 20% per year. And I believe it. I think that they have the potential to do it. They've actually done it in the past. After 2008, they were able to do it. I like it, but it's honestly meant for someone who's looking to hold something maybe another 5, 10 years. I think BPYPM, I know it sucks to open a different account, June, but let me tell you, when you see opportunities like this, it's a good idea to shift a little bit. Like I have an account with SoFi that I opened because I was stupid. I was just trying it out. I opened a Roth and put money in there. And of course they don't offer it. So what did I do? I just opened a Fidelity account. It took me like 5 minutes, transferred the assets into my Fidelity account, what's in my Roth, and bought by BPYPM in 24 hours. So I would honestly, even though I like BN long term, I think that this one is a very easy short term play that literally that could probably double on us in a couple of years. I don't think BN is going to double on us anytime soon. I think it's going to take time for them to recover and the valuations to get back to normal again. But I would say BPYPM is the way to go. The preferreds are just so undervalued that once people discover what's going on, people are going to be bidding this thing up like there's no tomorrow. So in terms of like just a quick tactical move higher, my goal honestly is buy PM, get the dividend payments, buy more BPYPM until it gets closer to its natural redeemable price of about 20 to 25, in which case then I can just actually take that money and shift it and buy BN. And I can even sell the entire preferred and just buy BN because BN has a longer, a much, what's the word, higher level of compounding that you'll get over the next 10 years. Whereas once BPYPM gets to about 25, like close to $25, there's really not much upside in terms of capital appreciation. All you're going to get is those dividend payments, which work for a lot of people. But me, I want both capital appreciation and I want dividends at the same time.
Yep. Perfect. That makes sense. Thank you.
Yeah. There is no options on BPYPM. That's right. Preferred shares do not have any options. That's not how it works. So if you're looking to do options plays on BPYPM, there's no options plays. So let me just clarify that. Anyone else have any questions? Here's a question. Does anyone here from Canada that knows Brookfield? Because in the United States, they may not be as very well known, even though a lot of their businesses are here. They are technically a Canadian company, but they're really good company. Let me just tell you, they're like the Berkshire Hathaway of Canada, technically, because they're incorporated there. But a lot of their assets are all over the world. They don't just have, by the way, buildings. If you look at Brookfield, the company itself, like the asset manager, they have infrastructure plays where they own Brazilian pipelines. They've got all sorts of things all over the entire planet. So how do you calculate the total fair value at being around $25 per share? Okay, so when it comes to preferred shares, there's something called the redemption price. So unlike common shares, which are just basically you're owning a piece of the company, with preferred equity, what you're doing is essentially loaning them money. So there is a fixed price that these things can get redeemed at. So the fixed price for Brookfield is $25. That's hard in stone. So there's no, hey, what if Brookfield gets the BPYPM gets the $30? There's no $30. It's 25 is the price that it's going to get liquidated. So I'm up here, and they've been a major player for a long time. Yep. That's right, Al. No questions from me, Bottom. As for Celsius, how will you know when it's time to sell the spreads? What are you looking for trying to learn about exiting options positions? Okay, so there's two things that I would say when it comes to spreads. Number one is how much time is left and how much risk you're taking on. So if we are at, let's say, 6 months away, and Celsius is trading way above our short leg, which is, let's say, it's trading at $50, I think it's just worth it to hold on to it, for the rest of the time, and just get the full 5x return that we may have had. On the other hand, if there are points where it's really near the money and just 6 months away, we kind of want to maybe take a little bit of risk off. So it just depends on the price when we get there. So there's not really any magical formula that I can give you. Just know that volatility tends to increase and spike the closer you get to the expiration. So right now, it's not really much we have to do. The price target for Celsius by 2026 is going to be way higher than the $100 amount that we have right now as our short leg. So I as of right now, I fully expect all of our contracts, our spreads on Celsius to fully price. Now, there's definitely going to be a little bit of, what's the word, like, just due diligence to make sure that their sales numbers are staying up. But right now, as of right now, everything is fine. There's nothing going wrong. These guys are executing like there's no tomorrow. Highly undervalued. Well, they're not highly undervalued. They're fair valued right now, but it's really close to our short leg. So right now, you could theoretically sell those spreads and make some good money. I mean, you're up. A lot of people are probably up 100, maybe 100 something percent. So we'll see what happens. What is the best case scenario for Celsius price in 26? I don't know, man. I don't know, but at a minimum, I think it should be at least $100. You know, input on snow. Input on snow. Snowflake is, in my opinion, a very undervalued tech play. I think a lot of people don't necessarily know them unless you really work unless you really work for what is that thing called? Unless you really work in the tech sector. They really did lowball their guidance. I'm gonna create some more posts on Snowflake. I'm not gonna talk about it too much right this second, but I don't think that there's a problem with Snowflake. I think in the second half of 2024, we're gonna see those guidance numbers start to get realigned, in which case Snowflake will rise higher again. But right now, the market is not giving them a lot of credit, and it's fair because they themselves put themselves in this almost low expectation world. But that's usually a good thing. When companies set expectations low, they can beat them pretty handily. So what's the next thing? Let's see. No question from me. Is there any light at the tunnel regarding Weight Watchers? I have no clue. I hope Q1 numbers for Weight Watchers is good. They tend to have a really good first quarter because a lot of people tend to, like, get on the New Year's resolution, but we'll see what happens. It'll be interesting to see what kind of numbers their what is it called? Their telemedicine product Sequence ends up coming out with total membership. So that one I have no idea right at this minute. I am from Canada and my brother works in Brookfield Asset Management for renewable energy sector. He's sharing the same story about the growth and acquisitions they make. That's right. That's right. So someone sent that. Could you touch on Apple? Apple is I think it's okay valued. I wouldn't say it's very undervalued at this point, only because there is a slowdown in their growth. But I think a lot of that slowdown will basically get dissipated in the future once they start releasing more AI related products. I think Apple is pivoting towards AI right now. They're still generating a ton of cash flow, still buying back a ton of shares. I'd say Apple is not a bad company to be in, but in terms of like options, I'm a little bit curious. I think I'm going to give it another couple of quarters to see where Apple does with their AI products, but I think that they're a sleeper in AI, so we'll see what happens. I am worried about a bit of a market correction, in which case Apple could take a little bit of a hit. But yeah, there's really not much to say about Apple at this minute. Just out of curiosity, if the Fed further decides to delay rate cuts, do you think there might be additional pullback to these commercial real estate tickers like BPYP and NVIDIA? I don't think so. I think at this point, everything is fully priced in terms of like how much the cost of capital to borrow is. So there's not really much left in terms of going higher. At this point, it's just when are they cutting? So yeah, I don't think that's going to be it. Do you talk about the recent National Association of Realtors 6% commission being I don't really care about that. I'm not. Yeah, it doesn't really pertain to me, so I don't know. Google. Yeah, hopefully Google figures out their AI stuff and we go from there. I really don't know much about how Google's going to proceed going forward. They really flubbed up on their releasing their Gemini thing, but hopefully that's something that they can correct. The valuation on Google at 130 was good. I bought some contracts which are up nicely. I'll sell them sometime in the future if I think that Google is. I'll sell the higher strike so that this will create a spread on it. So, all right, Danny, what's your question?
Hello, how you doing? My
Hey.
question is, if you have a spread and one is up, and let's say you're 180% up, and the
Mhm.
other one is not up, how
Mhm.
can you get your gains from the one that's up and leave the one that is not?
So that's the one thing that you can't do with the spread. You can't if you try to undo one leg, you are taking the liability of the other one. Each one is covering the other. So right now, let's say you have a spread, one of the legs is up 180%, the other one is down 80%. That means that your total gain is 100%, right? What's good is that over time, that short leg that you sold, as it's closer to closer to the expiration, it will decay. The other one will remain what it is today. So that's what we're banking on essentially. That the short leg ends up decaying away, basically.
All right, thank you.
Yeah. There is a way to close it for 100% gain but there's no way you could get 180% gain. If you leave the short leg, what you're doing is essentially opening yourself up to liability because and the broker won't let you do it. They'll just tell you like, no, like you sold this. That means that we need a guarantee that, you will have either the shares or the options that can cover it or the cash. And so not a good idea.
Thank you.
Yeah. So someone said, since most of us have no idea what Snow does, but I've always heard stuff about Snowflake. Snowflake is a giant data warehousing company that basically just stores data, essentially. But they do it in a way that makes things very efficient, very easy to migrate, and then also share that data across industries. And that's what everyone is pretty much banking on. Good evening. Any thoughts on Japanese company? There seems to be rumbling that their government is trying to incentivize companies to lean up. Maybe. I'm not sure. I mean, Buffett's all over there in Japan right now, just making a killing. So I wouldn't worry too much about Japan at this point. Speaking of Japan, does anyone like Shogun? Yeah, I like Shogun. I've been watching the show. It's really good. SLG, a keeper at the current levels. So honestly, I have SLG, but what I started to do was I started to sell SLG because it was in my IRA and I just converted those to BPYP. And SLG at current price, you're getting a 6% yield. If you sell it and you buy PPYPM, you'll get a 13% yield with a double probably. SLG could double from here, but it's a lot more fair value than BPYPM, which is undervalued. So if it's in a tax deferred account, it's a good idea to probably sell BSLG and buy a BPYPM instead. But that's up to you. If it's in a regular account, you're essentially going to have to pay taxes on it, which may not necessarily make sense, especially if it's under a year. So it all depends on it all depends on you, basically. Any thoughts on SoFi? I have no thoughts on SoFi right now. To me, they're just a bank. So right now, banks are not in favor. So I don't think there's really a lot of upside to SoFi for now. Chris, have you looked into Nifty international exposure being India hot an economy? India is great. I just don't really like investing in India because there's not as much transparency as I'd like. And so I'm staying away from it. I do have exposure to India via Brookfield because Brookfield Infrastructure has a lot of projects happening in India. So that's the only exposure I have. But I'm not touching India stuff for now. Let's see. Could you please give a few REITs that would qualify for qualified dividends? I don't know that many REITs that have qualified dividends. Kieran, just yeah, I'd have to really dig down and deep. Typically, when it comes to REITs, I only buy them in tax deferred accounts. So I never really focused on getting some qualified REITs out of the way from that. What timeline for BPY to reach $20? I have no clue. I think for me, my target is within the next probably 12 to 18 months. I think as commercial real estate recovers, leasing rates recover, BPYPN gets to $20. It's going to take time, but it'll get there. Chris, can you speak on the downside of holding BPYPM versus PBN while the price of BN is sub 25? Do you still have Key, Zion, CMA, and Regions? Yes, I still have all my regional banks. Those are in my dividend portfolio. So I'm collecting decent dividends from all of those right now. SLG versus BPY, great info. Thanks. Okay, no problem. Can you speak on the downsides of holding? The downside of BPY PM versus BN is that BN long term has much higher upside potential over a long period of time, whereas BPYPM is more positioned for a quicker recovery in the short term. So if you stay in BPYPN forever, the most you'll really get is that double from when it recovers to 25, and then the dividend payments that you're going to get. With BPYPN, there's a higher chance of capital appreciation of between 17 and 25% consistently for the next 25 years. Well, not 25 years, probably the next 10 years at least. Just how it happened in 2008. So right now, BPYPM is more tactical than BN. All right. Thinking of moving from Verizon to BPYPN in my Roth. Any thoughts? I agree with that. If you're going to do it, worth it. I think the topping out of Verizon would be probably $55 at the most, whereas BPYPN is a double. So I'd say BPYPM is the way to go. Yeah. So I think that's it. Let's see if there's any other questions anyone else has. Right now, there's just not a lot of great opportunities outside of what we're talking about. If we get a general market sell-off, that would be perfect because that means that we can buy things up that are undervalued. Right now, we've seen nothing but gains for the last, 6 months and after October. And because of that, a lot of valuations are just excessive. So slowly buying into EXTR. I've stopped buying into EXTR temporarily because I want to watch the private 5G networks and how these guys are doing. Instead, I've just been because of just how crazy the valuation is on BPYPM, I'm just been buying majority of my positions in BPYPM. I know I keep harping on these guys, but it feels like such an undervalued thing with a great return that, there's a lot less hurdle that I have in terms of getting a return from these guys than I do with other things. So, in terms of risk, this is the least riskiest, most rewarding thing. During the sell-off, how do you think BPYPM would fare? I think they'll fare great. I don't think they're going to get sold off at all because the market is recovering. You're getting a great return. So if you guys can see between all the ups and downs, these guys never really went down much. So fair value is very undervalued. So there's not really much room for downside. So yeah, if we do get a sell-off, I don't think anything really happens to BPYPM. And I think that's it. Unless anyone has any other question. iPhone, I don't know who iPhone is, but you can ask a question.
Hey, Chris, I just want to say I appreciate just everything you do. I know you feel like a lot of stress and pressure with all this, but yeah, to me, you're just an honest guy that's doing just great DD, and like that's as good as I can hope for. And I'm just real thankful that
Yeah, man, I
you're willing
appreciate
to
that.
do this.
I appreciate that. You know, it takes a lot of due diligence to figure out when companies have these undervaluations, because you know you're basically going against a lot of people whenever you say certain things or whenever you're finding certain things. So you know, you just have to keep doing what you're doing, and hopefully everything works out. You know, how else can we invest in BPYPM and Brookfield if we max out our Roth? I don't know. I mean, it's up to you, man. Just if you have any cash on the side, just buy some stock on the side. Pay the taxes on it. That's it. Uh, yeah, I appreciate that. By the way, though, I don't know who that was, but thank you. It really does. It does make all of this stuff worth it. You know. So I know right now we've had a episode that's a meeting that's a little bit more heavy on BPYPM, but honestly, that's where the opportunities really are. You know, are you going to do DD on Next, and should I look more into Cash Flow Chronicles? So Next is definitely something that I would say is good to hold really, really long term. I'm talking about 5 years out. This is probably going to go maybe a 20x, but it's going to take 5 years to get there. They're in the process of building out an LNG terminal, but it's going to take a long time. So I'm not going to tell you guys, hey guys, this is an easy play. We're going to make it. No, you better be in it for the long term. You better hold for a long term. And the entire time, you're not going to be making any money. So just you're going to have to be patient. But once again, the patient, the patience. I don't know. I don't have a metaphor for it right now at this second. But yeah, next decade has a lot of potential ahead of it. So we'll just stay patient with it. And eventually, I think this is something that everyone should be buying, but if it's just small, very small amounts on a regular basis. So if it's like, oh, I could spend $5 on a coffee, or I could buy a share of Next Decade. Just buy some Next Decade. You'll be drinking coffee for the rest of your life if everything works out in that stock. So right now I have maybe like 1,000 shares. I want to get to about 100,000 shares eventually of it, but I'm not going to do it right this
That
second because
mirror
I
there right there can smack you in the face. So that's why I like you guys to walk away from the street, right? As opposed to walking on the side of the street. These are things that you should be aware of when mom and dad are not there. Okay? You should always
yeah, that's right. I don't know I don't know who that was. But but yeah, so let me end it here real quick. If anyone's got any other questions, I'll be happy to answer them. What are your thoughts on CMCT? Yeah, I think CMCT is going to be okay. The insiders have just been buying like crazy. Once again, this is going to be a nice long-term hold. We're getting dividends while we wait, but CMCT does have like a lot of leverage, but the location of all of the assets that they have in Los Angeles are pretty good areas that are developing. So I think eventually CMCT is either going to go bust, or it's gonna go up in value like a good amount. So right now I'm just being patient with CMCT. You know. Let's see. I think it's it. Still slowly adding Accelera. Yes, and the thesis has not changed. With Peter Thiel leaving, no. Peter Thiel was brought in to help with the IPO. He did that. He was there for a while. The CEO at Accelera, Carl, I forgot his last name, but he was a big fan of Peter Thiel. Brought him in during the IPO. The company is good. They've got strong partners. So once again, Accelera is another like 10-year hold. This is not something that's going to make money overnight. So if you're in Accelera, just be ready to be patient. You know, so that's what you got to do. Sometimes you got to have this barbell strategy where you have your main guys that are your big winners that are going to, keep your portfolio going in the short and medium term. And then you have your moonshot plays. The moonshot play in my portfolio is Accelera and Next Decade. After rumor of Toyota's water-fueled car, I don't know. I don't have any thoughts on water cars. So do we get alerts when you're buying, or is it mostly Discord messages? Just Discord messages. I don't do like a buy and sell service. That's just not me. I will basically have a model portfolio out. By the way, I am going to create a different Savvy Trader model portfolio just for the Patreon. I'm going to lock it up so no one else can be in it. But basically, it'll be all the companies that we're covering, and this way people know what we have. On Savvy Trader, I've basically consolidated everything to try to just win this stupid contest that they have, where it's like a total return thing. So right now, most of my position in Savvy Trader is just BPYPM, which I think is going to beat every single other person in the Savvy Trader universe. So we'll see. Chris, when you get a chance, take a look at DNLI. I will do that. I just need to write that down. Just give me a second. DNLI. Okay. All right. And Chris, okay, that's about it. Do you have any thoughts on Kava? I have a Kava near me. Not as good. I don't like it. Some people are saying it's the next Chipotle. I don't know about that. We'll see though. Amazon. Okay. Amazon, great company. If you're looking for a nice, like healthy play to go into that'll yield a decent return, Amazon is the way to go. They're in harvest mode. All the expenses that they made over the last couple of years, they're basically consolidating all of those down, and so they're just going back probably into share buybacks. We'll see what happens going forward, but if you want to hold a good company long term, Amazon is the way to go. Especially among the FANG names, I like Amazon as one of the best ones that are there. And yeah, I think that's it, guys. So thank you for being on here with me. I am going to try to do these more. There is a feature on Discord where it allows me to create a quick meeting on Discord. Once I figure that out with Sam, I will definitely utilize that more, because I don't like how this worked out with me having to share and it not working 100% right. But yeah, I'll figure that out and we can do this a little bit more often. All right. All right, guys. Well, have a good one. I'll see you guys. Take care. This was good. All right. Have a good one. Take care.